Well, welcome to another Workshop Wednesday brought to you by schoolofbookkeeping.com, where it's casual conversations for serious workflows. And welcome back from the holiday, Rachel. I hope you had a great Thanksgiving.
Yeah, it was really great. Definitely happy to be home though.
Awesome. I myself had a great Thanksgiving as well. So hopefully everyone watching did as well. So in case you were wondering and noticed, we were originally having scheduled to have Shawn joining us again from Katana, but we had a cancellation last week due to illness and whatnot. So we kind of pivoted, and we also I didn't confirm that this week was good enough for him. So
how dare you?
A little bit of panic this morning, but we fortunately I already had artwork created for next week, and so we are going to talk about today the subtle nuances of accounts receivable in QuickBooks Online, because there are some differences between desktop and online when it comes to accounts receivable. So before we get into our topic, we did have an announcement that the Workshop Wednesday will be eligible for CPE credit coming really soon. So,
Yay!
We're going to be partnering with Earmark on their application to be able to get CPE credit just by joining or watching the Workshop Wednesday. They will take care of the whole administrative aspect of getting your CPE. You can watch us live, and then when it's available, typically it's going to be 5 to 7 days after the workshop. You can then take the quiz to qualify for CPE. So just by listening to the workshop, you can get some CPE credit. So coming up on the deadline for a lot of people, so we thought that might be a good use for that. But just by listening to the Workshop Wednesday, you'll be able to get some CPE credit. So,
and who doesn't want to listen to us talk endlessly about QuickBooks? Exactly. I mean, I know my kids don't want to, but there are people out there, and it's so funny because every time I tell people what I do, if I'm talking to another accountant, and they're not really like my QuickBooks friend, they'll usually say, "Oh gosh, I wish I knew more about QuickBooks. Oh man, I wish I, was an expert at it. I wish." And it's really something that, if you're not spending a lot of time in QuickBooks, it can be really, really tricky, and especially with what we're going to talk about today with AR and matching payments. And oh man, I mean, that's, I think, the one thing, and I'm so glad we're talking about it today, because the one thing that I see messed up the most, I think, is AR.
Yeah, and I think this all stems back to the prescribed QuickBooks workflows, and those are superseded by convenience. That's when people get themselves into trouble, right? Because you have, in the sales process, you may or may not have, prescribed workflows that you as a business owner would take take advantage of, right? Where you have a non-posting transaction, which would be an estimate that would then get turned into an invoice transaction. And then later you would receive a payment. And then later you would then have that deposited into your bank account. So that workflow of, the hip bone connected to the thigh bone, connected to the, the spine or whatever, the next logical bone to be connected to, when that is superseded, and this is where net deposited kind of gets its name, right? Is that if someone is just going into their bank and depositing receiving a deposit and posting that to revenue, that's when people get themselves into trouble, because they've had all of these other workflows connected to each other, and then they just put a deposit in, and then now they've got a mess on their hands, or you've got a mess on your hands as the as the accounting professional. They don't really care, right? I mean, is that kind of the summation of what you've seen in your
Yeah, I mean, I've seen, it's usually like one of two things. It's usually I will come across folks that really understand using the accounting software, not necessarily QuickBooks, but the concept of, we're going to tell the software what's happening. Things may come through the bank overnight, and that's fine, but they have a general understanding that there's two sides to everything. And I don't even necessarily mean debits and credits. I mean, I was just at the bank yesterday making a deposit, and I remember, get my deposit slip. The deposit slip goes with the thing, because you got to have two sides with every single transaction. And so in the world of banking, it's not how it is in accounting, but the logic is still the same, right? We need to have a deposit slip saying, I'm making a deposit. Here's the check. This is the amount that's going into the account, but I got to have something to tell it what's happening. And so that's usually like, whenever I kind of talk with the folks that are like, okay, I got to make sure I get this into QuickBooks, they understand. Like, I usually just boil it down to this. We're just telling the software something's going to happen. I'm telling it that I'm billing somebody an invoice. I'm telling it that I'm writing a check. I'm telling it. The stuff then comes in through the bank feed and will match to the things that we told it. Yeah. Then I run into people who have zero knowledge, and they're just really trying to monkey something together. Now, I have been there. I have done that. I get it. And in today's world, we have ChatGPT. So there is no better place to literally ask it, how do I ... in QuickBooks, and it will give you a step-by-step. So in, this day and age, things should be, even if they're not an expert. I mean, there's resources there. I mean, things really should be entered in correctly. Otherwise, you're going to have a mess on your hands.
Yes. So let's start with the basics, and we'll talk about the definition of what accounts receivable is. And I remember when I applied at Intuit, that was one of the interview questions that they asked me. And transparency, I had no clue. So I did one of those circular answers when they asked, like, what is accounts receivable? I was like, well, that's an account that you receive.
Oh my God,
just totally. I always said this, like 10 years later after I got hired, that if I had to get hired by Intuit again, I probably wouldn't have.
Yeah.
Because I would have failed, the proficiency exam or something, like that. So somehow I got in, even despite that horrible answer of what accounts receivable is. So I'm going to ask you, since you're going through your master's in accounting, what is accounts receivable? And don't say it's accounts that you receive.
Well, there is a receiving part of it, but Jeff. Okay, so I'm not going to get into the nitty gritty of cash versus accrual. We don't really use accounts receivable when it's a cash basis. usually when I'm talking about accounting, I am always talking about accrual accounting.
Yeah.
That
so
is
I'll
the
ask
way
you. I
corporations
want you to give the textbook definition, and I'll
yeah.
give the QuickBooks definition.
Yeah. Okay. So, and again, usually when I talk about accounting, it's usually how does a corporation do it in a business? So there is in the accounting software a way to, again, tell the software that I have earned the money. Okay. So in QuickBooks and any software, that is the creation of an invoice. And so for our purposes today, I'm just going to say invoice. So I have, let's say I am a landscaping company, Craig's Landscaping, and I did some work for the month, and I'm going to send my client a invoice. Okay. It's up to me. I may give them 30 days to pay, but that invoice gets recorded to the system on the day that the invoice is issued. And that is when we have earned the money. Okay. Now, they get your customer gets the invoice. Maybe they don't pay it for 25 days. They pay it, and maybe they pay it in the next month. Well, that is just the cash that's received. The invoice was already recorded to revenue. So an invoice is the revenue posting source document. Okay, so in accrual basis accounting, that is the invoice date. So it's up to you whether you invoice ahead, maybe you invoice behind, but that invoice date is gold because that is when you earned the money. When they pay that invoice, that could happen long down the road, and you never get that invoice collected, but it's been earned. So it's on the books as of the date that the invoice was issued. And let's say you've got multiple invoices, that is called accounts receivable. So that total of all of your outstanding invoices, and in QuickBooks world, when we send somebody a source document, it's an invoice. When I receive something to pay, it's a bill. But so when we're talking about invoices today, I'm invoicing my customer. Mm-hmm. And so it's that source document. You send 1,000 invoices. That's my accounts receivable. And in QuickBooks, you can run what's called an AR aging, and it will show what invoices are due to you to be paid 30 days, 60 days, 90 days. And so that's the gist of accounts receivable.
Yeah. And the way I would explain people, when they would call in and like why is this so important is because, and you can probably relate in your e-commerce world of clearing accounts. I mean, it's really, that's what accounts receivable does as far as QuickBooks is concerned, is accounts for the passage of time from the time that you create an invoice to the time that you receive payment, right? Just like undeposited funds is a clearing account of the time that you've received a payment and the time that you take it to the bank and actually deposit it, right? So that's the QuickBooks definition of that account, is that it's really just a clearing account. It's it is it classifies as a special account. I'm going to use air quotes, not like it's a short bus, type of special account. It has functionality tied to it, so that the workflows connect together, right? So their invoice and payments and credits and those types of things all come into this accounts receivable account, and then they get applied to each other and connected to each other, so that the open balance, as you were saying, will get paid, right? And that's how QuickBooks reconciles that account, is by applying open transactions together so that they are paid or closed, and then they're no longer open, right? You were going to say something while I was interrupting.
No. That's super. That's the gist of everything. And so, like, just back to when I was making a deposit yesterday at the bank, it's like that's what double entry bookkeeping is. There's a debit and a credit for every side. If you don't need to be an accountant and understand, that a credit increases accounts receivable, but you do have to sort of understand this this concept of that we're always going to have two sides. And when I say two sides, I mean invoice payment, invoice payment, invoice payment, invoice payment. Now, we do a lot more, volume and stuff sometimes with the credit card swipes and, all kinds of stuff. That still has invoice payment, invoice payment. It may not be an invoice. I'll usually call it a sale payment. We reconcile in those clearing accounts. Like you said, there's always two sides. So in accounts receivable specifically, it's invoice. What pays it? Cash. And so those two meet up. Now, I've worked in places where people, like, say there's an invoice for $500, and then a payment comes in for $750. Let's say the person writing the check on the other side misunderstood, or just wrote the wrong amount. I've had it where I'm places that I've worked where the people just apply that wrong amount to that invoice, and that doesn't clear that out, right? So I'm a stickler for the exact payment. It has to clear out the exact invoice. Or if they're writing a check to pay several invoices, they send some kind of remittance or something of what's being paid. So that it can get real ugly is basically what I'm trying to say. It can get really, really ugly. And AR clerk that really knows what they're doing is worth their weight in gold, because sometimes they really have to make sure that they really understand how to apply payments. Yeah. Now, QuickBooks is, and you'll probably get into this, QuickBooks now has so much razzle dazzle that it'll automatically match those payments up. Even if it's a complex deposit, it'll find the invoices and it'll match them up and all that jazz. Yeah. But I'm really kind of just talking to the mechanics underneath it.
Yes, and that's where things get really difficult when you're in the throes of a cleanup project or something like that, where you have misapplied payments or credits tied to different things, where QuickBooks in its infinite wisdom automatically applied something that you didn't necessarily want it to a specific one, and then sometimes you have to go in and reapply those things, and that's a whole workshop in and of itself. But what I wanted to really focus on this workshop is the subtle differences between maybe desktop and online when it comes to accounts receivable. Because a lot of times when you convert from desktop to online, some of those workflows don't really tie together too well because of the specific nuance of how accounts receivable, or in this case, how accounts receivable behaves inside of QuickBooks Online. And that's what we want to focus on today, is those subtle differences between the two platforms. So the first thing is multiple accounts receivable, right? So QuickBooks Online wants you to only have one accounts receivable. Desktop, now I've got the desktop showing here, but I have something blocking my way. Where is, okay. This new layout is horrible. So here's QuickBooks Desktop. I have created a multiple accounts receivable, and every accounts receivable transaction will have this drop down here at the top where I can choose various accounts receivables or not. And I can, create these as a hierarchy, so I can have a parent accounts receivable and sub accounts receivable accounts. What is the reason, a business case for why you would have multiple accounts receivables, Rachel? Would you even advise on that? I mean, I know this is a desktop thing and you're mostly in QuickBooks Online, but have you seen in your business experience that where they have on their chart of accounts multiple accounts receivable accounts?
Yeah, I mean, it's basically just a subledger, right? I mean, and we have hundreds of subledgers that all go into the general journal. But for me, it's too complicated. I just want one accounts receivable. Already, like accounts receivable is my least. Okay, never mind. Payroll is my least favorite thing to do. Then accounts receivable. And I don't know. I just wish that, I don't know, if QuickBooks could ever come up with a way where all of that is automated and I just don't ever have to touch it, that would be a nice day. But yeah, I like it just all in one because the way that I think about it is a lot of my clients are invoicing out of QuickBooks, but a lot of them are also, selling online or selling in a store or whatever, taking credit card payments. So those sort of have their own clearing accounts. So I like to have the invoices that my clients are issuing and doing, or even if we're doing it for them, I like to have those all in one account. I want one undeposited funds. I want one accounts receivable. That way I'm not having to go, oh, that goes in that one and that goes in that one, because there's always going to be things that are messed up. So for me, it's easier for me to wrap my head around it when it's just one AR, unless they're it's a requirement for their business, or
Right.
I don't know. Sometimes like some franchises have certain requirements and stuff. If I had the choice, I would choose not to do that.
Yeah. So, and this is a double-edged sword as well, because if you create an invoice on this, I have this departmental accounts receivable account. If I create an invoice and assign it to that, and I receive a payment on the main accounts receivable account, I can't connect the two because it doesn't have that flow through workflow.
You're opening up room for error by doing that.
Yeah. So easily enough, you go into the transaction and put it to the right AR account, and lo and behold, you can apply the credit or the payment to the invoice. But it's possible in QuickBooks Desktop to do this with multiple AR accounts. QuickBooks Online, no such thing, right? So so this could potentially be one of those surprises when you move a desktop company to QuickBooks Online and they have multiple AR accounts to begin with, because QuickBooks Online will only support one, and that's going to be the default one. It says here in this article here, with a survey. Hold on a second. There we go. With regards to accounts receivable or accounts payable accounts that you have duplicates, it will say your default and only AR and AP account are the ones that were created when you set up your company or you selected during conversion. I've never seen that selected during conversion process, so I assume it just chooses one of them as a default one. But if you do have to group or subdivide your open payables or receivables, it gives you other options in here to create parent account, parent customers with sub customers, to group your open receivables, or using location tracking, to be able to do that. Right. So there are ways to work with that. And if you want to see this article, it's right here. There we go. Okay. So there's a QR code there. You can snap a picture of it. And that would be a way to be able to do that. But if you do have multiple ARs and it comes over into QuickBooks Online, and you want to transition to this, as it's saying in here, if you already have multiple ARs or AP accounts, consider merging them, right? Because there won't be a drop down on any accounts receivable transaction to be able to choose one over the other. It's always going to go to just the default AR account, and then if you do merge them, then you can use something like this to separate that out, so that you still have the departmentalized option with regards to a business need for to be able to do that, right?
Yeah.
So that's one nuance. The other nuance is, I have my notes here. Let me just pull this up. QuickBooks Online, unlike desktop, this is one where QuickBooks Online gets the nod. When you do need to move transactions from one, if you do have multiple ARs, or if you have a transfer of credit from one customer to another. Typically in QuickBooks Desktop, you have to do 2 journal entries or use the transfer of credit functionality, which it creates the 2 journal entries to do that, because it doesn't allow the desktop doesn't allow you to create a transaction that references more than one accounts receivable or accounts payable account. So if you had a customer who was also a vendor and you wanted to move their credit, from one to the other, you still have to make 2 journal entries in order to do that. So QuickBooks Online allows you to have one transaction with multiple references to AR as many times as you want, right? So that's one of those nuances that you're able to do inside of QuickBooks Online. So if you have like this wash account, or maybe an adjusting customer, just to put something on the AR balance, and then you want to go later and split that out to specific customers, you can do that on one transaction rather than creating these multitude of journal entries to be able to split that adjusted accounts receivable or accounts payable balance and split that out into the individual customers that you want to have those balances. So that's another nuance, and tip of the hat that QuickBooks Online allows that and desktop doesn't. Sorry, desktop. So there's that nuance as well. And then cash basis. Now, I know you said you didn't want to get into cash basis or accrual, but there is a common question where you have, where did I have it here? There we go. Okay, so on a cash basis. Now, in the grand scheme of things, as you mentioned, an accrual basis, you recognize the revenue on the day that you record the invoice. On a cash basis, you recognize the invoice or the revenue on the day that you receive the payment. Right. So that's really the QuickBooks nuance of all of that. So in the grand scheme of things, if I have an invoice that is not paid, I would not expect it to show up on a cash basis balance sheet.
Correct.
If it's not been paid, right? So so normally, the expectation in QuickBooks is that if I run a cash basis balance sheet, I would have no balance in my AR, because
you're saying balance sheet, but it's P&L.
No, I'm saying on the balance sheet. The article I'm showing here is a balance sheet. So if I have a $100 invoice and it's not been paid, and I run a cash basis balance sheet, I would not expect to see that $100 in my AR balance on my balance sheet. However, a lot of times you will see a balance on a cash basis balance sheet in accounts receivable or accounts payable. And that there's a reason for that, right? And typically it's down here in these articles. But what it boils down to is that on an invoice, you have a line item or something that is pointing to another balance sheet account. And in this case, the first one here is sales tax, right? So when you create an invoice at $100 and you're collecting 8% sales tax and it's not been paid, the sales tax payable needs to be affected even on a cash basis account balance sheet. So that 8% will show up in accounts receivable, not on sales tax payable.
Okay.
Right. And the whole reason behind that is that these balance sheet accounts need to be impacted even if the transaction's not paid. The only place that QuickBooks has a place to put that is in accounts receivable. Gotcha. Right. So Otherwise, you'd have a balance sheet that's out of balance, and that's false advertising.
Yeah.
Right. So
Yeah.
in order to do that, so another scenario is security deposits, right? So if you've taken a deposit, you're typically going to put that on a balance sheet of unearned revenue or whatever that might be. In order to keep that in alignment, it's got to put that somewhere on the balance sheet to offset it, and that will be in accounts receivable. And this amount is not reflective of the total amount of the invoice, right? So that's what gets people confused.
Yeah,
because
confused.
The other big thing is inventory items, right? So if you have a sale that involves inventory items, the cost of that inventory that's not paid for yet, needs to be reflected. And so that's where you see like all sorts of weird numbers showing up in your cash basis accounts receivable balance sheet.
I see.
And that's where people get
so
really
it'll put the
confused.
COGS amount in, recognize that in AR, even if the cash basis invoice hasn't been paid.
Correct.
Oh, I didn't realize that. Okay.
Now, I know that even if they are paid, cash basis financials, when inventory is used in QuickBooks Online, are wonky to begin with. So
yeah, I don't ever use cash basis, even for service based folks. It's just not my thing. But I was going to say the other side of what you were saying on the P&L is that on a cash basis, I just wanted to mention, you still are creating an invoice. You still have the two sides. The invoice is posted to QuickBooks, but you're not putting it in revenue at that time. It's just sitting there. It's when that payment is received is when the revenue is recognized. So if you're looking at a P&L, if you're on an accrual basis, and I've just created a whole bunch of invoices today, it's going to show up in my month of December as revenue. If I'm on a cash basis and none of those are paid until January, that's only going to show up in January. And so that will get posted directly to revenue. Now, the reason that I don't do cash basis is because it's been drilled in my head. Just all of my education for accrual-based accounting. I do all of my data entry on an accrual basis, just period. That's, for me, how it does it. If there's elements of QBO, sometimes we'll add things out of the bank feed, some expenses. So it's not, like you said, it's like quasi accrual basis. It's mostly accrual basis. We do all the data entry on an accrual basis. We can then run a report on a cash basis, and where that would be really advantageous is this time of year. So if I have a client who invoices a whole bunch of stuff in December, and he typically doesn't get paid on that for 60 days. So what you're doing is you're pushing your income tax liability to the next year. Now, you're not saying I'm not paying it. You're just moving the date. That's it. Because I know that some people get confused and they think that, it means something else. All it means is accrual basis means I'm recognizing the revenue now, and it's probably going to increase my tax liability, or I'm going to recognize it next year. And so for this year, it'll decrease that, but next year it'll increase it. So it's literally just moving a time. So that's all it's doing.
So if, and that brings up a good point, because we're coming up to the end of the year. If you are filing on a cash basis and you're using accrual-based transactions like invoices and whatnot, you may need to make some kind of adjustment so that they're in alignment. This article here actually does give you the steps to take and how to make those journal entries to be able to have that align for the year end, and then on January 1st, you have that reversing entry created so that it puts it back the way it needed to go. So, so this is a good article. I have it. Also, that's also a QR code there. You can snap a picture of that. I was very limited on the title, so that's what CBBS is: cash basis balance sheet. In case you're wondering, for those people at home.
So anybody that is wondering, in QuickBooks Online, in the reporting section, in every financial statement, balance sheet, and P&L, you can run it on a cash basis. Because sometimes I'll get new clients and they'll, I'm on a cash basis. I'm like, no problem. I can run the report on a cash basis anytime you want. So I love QuickBooks for that, because for my folks that do, and I have a lot of people filing on a cash basis, but for our purposes, we just record the revenue at the point of invoice.
Now, one last thing that we want to talk about, a subtle nuance of accounts receivable, is a situation where they are on a cash basis and the invoice has a negative amount on it.
Oh, right?
Boy. This could be a discount, or an exchange. Maybe they're exchanging items or something like that. It's best not to do that, right? Because the definition to QuickBooks of a payment, the definition of recognizing revenue on a cash basis is based off of the date of the payment, right? Yeah. So if you have a negative amount on what would normally be a positive amount transaction of an invoice, and then you put a discount on there, QuickBooks assumes that that's a payment, right? Right. So the way that it will do that, so let's say you have a $1,000 invoice and you've given a 10% discount, and you put that on the invoice, then and you have multiple items, right, on that invoice to begin with. QuickBooks will then take that $100 discount, which is now it's seeing as a payment on the date of the invoice, and will proportionately apply that to all of the open invoice items on the invoice. So when they're looking at their cash basis reporting, and they see weird numbers of, well, what's this? I did not sell this item for $3.55. But then they drill in on the invoice, and there it is at its regular sales price of $150 or whatever it is. That's what QuickBooks is doing on a cash basis report, is taking those negative amounts and applying them proportionately on the date of the payment, which is the negative amount that's on the invoice. So best practice here is, when you have things that would be reducing the overall balance of an invoice and you're running things on a cash basis, don't use negative amounts on the invoice. Instead, create a credit memo for those things, and that will allow you to be more explicit of when you apply those things together, right? Yeah. So you can change the date of the credit memo, put it to whatever date that you want that to be recognized, and then when you apply your credit memo to your invoice, then you have all things looking swell.
Yeah.
That's
and
another
then in a credit memo, I'm guessing then you can create a product service called discounts, and then that will go to the appropriate place.
Yeah, which you would still do. If you did create a line item that's discounts as a negative on the invoice, the credit memo would just be a positive.
Right. Okay, I see. Yeah. Now, I see so many people put a negative as a line item, like so many.
And in and of itself, it's not a bad thing. if they're running all their reports on accrual basis.
Right. But I know some people do, especially that are invoicing, because I don't really have a lot of people that are invoicing with long terms. So, but there are people that do. So the thing is if you're giving 60 to 90 days, which in this day and age, I'm horrified. You can invoice in December and not get paid till February, March. So there are people that really do want to run on a cash basis. So, and like I said, I mean, if that's how they file their taxes and that's how they need to do it, great. But I don't run into that for my clients too often, but I know people do.
All right. Well, I think we've exhausted all the subtle nuances of accounts receivable and QuickBooks Online. Hopefully this was helpful, and we'll see you next time on the Workshop Wednesday, and we hope you all have a great day.